Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 25th, 2025. Hey, how you doing? How are you? I hope you're doing well. I hope you had a good trading week. I hope you're having a good weekend so far. Um, I am still in Colombia, in Santa Marta, Colombia, and I just wanted to share this picture with you. This is the beach that I go to each day and play baseball and go on the water, have fun with my girlfriend and my dog. But one thing about Colombia is just the beautiful array of colors. This picture really doesn't do it justice when you're there in person. It's just awe-inspiring. But really enjoying my trip. I keep delaying my trip and delaying my trip, and I guess that's one good thing about trading. It gives you the ability to trade wherever you are. But I do have to come back in February because my visa stay is going to run out. But going to make the most of it while I am here. So, all right. Well. Like I said, I appreciate you being here. I hope this is going to be helpful for you to get an idea of how I choose my trades and how I manage my trades. But the format is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades and all the positions that I currently have. We're going to talk about when I entered the trade, why I entered the trade, what the strategy was, what the setups were, what I saw in the signals that made me take the trade, and then we're going to talk about how I position size. We're going to talk about where I place my emergency stop, my end of bar stop, how I take partial profits, how I exit half of the positions um, when certain price action happens, and then how I am going to exit the entire trade. So basically, when I entered, why I entered, and how I am managing the trade going forward. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading, everybody, is the ability to create a plan and then follow it. That's really what it comes down to. Really, whether you trade like I trade or other people trade, you have to have a plan and you have to follow it. What happens is we get emotions come in and it gets us off our game. I've been trading for almost 30 years now, and the key is, everybody, create that plan and follow it, whatever it takes. And if I can help you with that, let me know. But that's how you're going to make money in the long run, is following your trading plan. After that, every Friday night, I go down through my master watch list, both on the daily time frames and the weekly time frames, and I look for potential trades for the next week. Now, they're not where they need to be, but if they get to where the sweet spot of the setup is, then I'll consider taking them next week. But like I said, I go through the watch list. I look at Apple, for example. Apple's one of them. We're getting close to the 200-day moving average. We're getting close to a potential deep dip buy. But on the weekends, if you can go through, look at charts and say, okay, well, it's not even close to there, but there would be perfect because maybe you have an under 30 over 30. Maybe you have a 200-day moving average there. Maybe you have a double bottom bullish divergence forming. You have a bullish order block. You have a bullish fair value gap, or maybe all of them together. That's what I am looking for. And most of them will not get there next week. But and if they don't, fine. I'll just move on to another market. But always something will get to that sweet spot, to that one spot where things are lining up, the stars are lining up, and then that is the place to buy. Now, it doesn't mean it's going to be a positive trade even if it gets there, but it does increase your chances, and that's what trading is about. It's the numbers game. It's being patient, waiting for a market to get to a sweet spot where the stars align, where there's multiple confluences, combinations of indicators lining up signals at that one spot. And if it gets there, consider taking the trade. So that's what I'm going to share with you, both on the daily time frames and the weekly time frames. Certain areas on different symbols that if they get there, there's multiple signals, there's confluences. So I hope that's going to be helpful for you, giving an idea of how I look at trading, where I'm looking to take my entries. And if you do find something helpful today in this podcast and something of value, all I ask is that you can hit the thumbs up button or subscribe to the channel. It really does help the channel out and lets YouTube know there's some valuable content. So with that, let's get this U.S. legal disclaimer out of the way, and then we'll come back and we'll get started. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks so much for hanging through that with me, and let's get started. So first, the first daily position that I have is IWM. This is the Russell 2000. So I always try to look for a confluence of signal, not just one signal, but two signals. And on this one, this is a deep dip buy. This is a buy off of the 200-day moving average. 200-day moving average is a major moving average that large financial institutions and experienced traders look for as a line in the sand. And the 200-day moving average tends to be a magnet. This is the black one. So on the particular day that I bought this on the 13th of January at 217.40. So first of all, why? Well, we had an intraday rejection of the 200-day moving average, the black line. So during the day, we went under it, but we closed over it. What does that mean? That just means that there were no more people willing to sell under the 200-day moving average. So I went in here, bought it with the rejection of the 200-day moving average, but I also like to look for confluences. So what was the other signal? The other signal was a V1. A V1 consists of two bars, bar 1, bar 2. On the day that I bought it, it went under bar 1's low and closed above bar 1's close. I also use V2s, but they use 3 bars. V1s, V2s are great signals. They complement any entry, they're entry signals, but they complement any setup. And if you'd like to learn more about those, go to my YouTube channel. I have a video there on V1s, V2s, where I kind of get into, all the rules. But this was the confluence of setups. Rejection of a major moving average, deep dip buy. Cherry on top was the V1. Goes under bar 1, closes above bar 1's close. So I entered at 217.40. Now, soon as I see the entry, I have to decide how many shares I'm going to buy. The most important component of trading for me after 30 years of experience is position size. It's so important. So let me show you how I do that. So it uses two components. The first component is how much do you have in your trading account. The second component is what is the value of the 2 ATR. ATR means average true range. This is the average true range times 2. So it's 2 times the average true range. So let's just say I have a $50,000 trading account. It doesn't matter if it's 50,000, 100,000, million, the math all works the same. But let's just say $50,000 trading account. I take 1% of whatever my trading account is. Let's use 75,000. I don't use 75, just to show you you can use it on anything. $75,000 trading account, 1% of that is $750. So I take $750 divided by the value of the 2 ATR. This is going to change each day, but right now it's 766. So $75,000 trading account, 1%, 750 divided by, right now it's 766. That just shows me to buy 97.9 shares. Roughly, I would just round it up to 98 shares. Why is the 2 ATR important? It measures volatility. If volatility is very high, this number is going to be larger. And if you divide a larger number into your maximum allowed risk, you're going to get a smaller amount of shares. If volatility is lower, then this is going to be a smaller number, you're going to get a higher share. So it's important to adjust for volatility. When there's high volatility in the market, you want to buy fewer shares. So that's why I use this formula, and it works on anything: daily time frames, intraday time frames, weekly time frames. And it's so important to position size based on volatility, and the 2 ATR does it all for you. So $75,000 trading account, 1%, 750 divided by the value of the 2 ATR, 97.9 shares. I'll just round it to 98 shares. So for me, and the way that I trade, if you have a $75,000 trading account, this is the perfect amount of shares to buy based upon the current market conditions. Okay, so I have the rejection of the 200-day moving average and the V1 as my entry signal. Buy 217.40, 98 shares. Now, the first thing I do, I want to look exactly at what my 2 ATR was. Remember, it was 766. I want to take my entry price and I want to place my emergency stop exactly the value of the 2 ATR, 766, below my entry. This is my absolute emergency case. If it goes down the next day and gets down to the emergency stop, 2 ATRs below, how much have I lost? I've lost the $750 because we did the math, right? 750 divided by the value of the 2 ATR shows me 98 shares. So if I have 98 shares and they move against me, 766, how much have I lost? 750. Now, the good news is that this only happens about 5% of the time. The other 95% of the time, if you have a loss, it will be an end of bar stop. Now, an end of bar stop, I wait until the end of the day because the closing price is the most important price, because you have large financial institutions coming in at the end of the day. They're dealing with the most money. They have very smart people. They have the best information. I want to follow what they do. But the emergency stop, if I hit that at any point during the day, whether it's 5 minutes after the market closes or 5 minutes before the market closes, I get out there. I can't wait until the end of the day because I know my worst case scenario for my risk tolerance for that particular day is 1% of my account. Like I said, only 5% of the time that happens, but the other 95%, I wait for the end of bar stop. Why did I take the trade? Well, I took the trade because of the rejection of the 200-day moving average. So therefore, my end of bar stop is simply a close under the 200-day, right? That's it. That's my line in the sand. That's what's so great about deep dip buys. You have an absolute line in the sand. Above this, I'm staying in. Below this, I am getting out. Okay. So we position size, we waited for the entry, rejection of the 200 plus the V1, position size correctly using volatility, using the 2 ATR in our count value, place our emergency stop exactly 2 ATRs below. We know our end of our stop is a close below the 200-day moving average. Now, what's the next thing I do? The next thing I do is I look at the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is 5.74. So I take my entry price, I add the value of the 1.5, and I put it above my entry. Why do I do that? Well, once it gets to 1.5 ATRs, you can see it was here, we're above it, I'm in trailing stop mode. If you get to trailing stop mode, you don't do anything per se. It's just that now you're in trailing stop mode. All that means that once you reach trailing stop mode in the future, if you have a close below a previous bar's low, I'm going to exit half. Because once you start getting up 1.5 ATRs above your entry, you're pretty far up there. You don't want to give everything back. So if you have a close, if it's going to come all the way back down, most likely it's going to start with a close below a previous bar's low, right? So that is a defensive move. And you can see we've got to the 1.5 ATR trailing stop level, but we have not yet had a close below a previous bar's low. And again, if it does do that, I will exit half of the remaining shares. So the position sizing, the emergency stop, the end of bar stop, the trailing stop level, these are all defensive moves. In other words, if they go against me, I'm going to take action. But I also like to play And that's a defensive action. But I also like to play offense. And how do I play offense? I play offense by taking partial profits if the stock moves up a certain amount from the previous bar's close, or in other words, I sell into strength. So I'll show you exactly how I'm going to do that on Monday. So I take the closing price that happens every day. Just look at the closing price, 228. 67 is the closing price. And now I look at the 0.45 ATR. And the 0.45 ATR is $1.72. So every day I do this. I take whatever the closing price is of the day. I look at the value of the 0.45 ATR, which is now is $1.72, and I add those together. 228.67 plus 1.72. 230.39 is my first profit target on Monday. I place 3 profit targets every day. I place limit orders. So my first profit target is 230.39. Then I take my first profit target, 230.39, and I add the value of the 0.45 to it again, plus 1.72. My second profit target for Monday is 232.11, and I do it one more time, 232.11 plus 172. My third profit target is 233.83. So I put in 3 limit orders each day. I do it the night before, using exactly this formula, adding the closing price plus the 0.45, and I do it three times. So how much do I take off at these profit targets? 10% of however many shares I have going into the day. If I went into the day with 500 shares at these 3 profit targets, 50, 50, 50, right? If I have 100 shares going into the day, 10, 10, 10. And that's it. I like to play offense. I like to take something off, not everything, just 10%, 10%, 10% every single day. And the nice thing about that is you lock in these gains. The market can't take it away from you. You're reducing your position size while it's going up, which is smart. And if it moves up, moves up, moves up using this approach, you'll always get something right near the top. And I think it's balanced, right? In sports, you can't just play defense, you can't just play offense, you have to play both. So that is how I position size. So that's it. Rejection of the 200-day moving average plus the V1, position size, emergency stop 2 ATRs below, end of bar stop, close below the 200-day moving average, place my 1.5 ATR trailing stop level above, and I take partial profits as it moves up. So here we go. Bought here on the 13th at 217.40. Next day moves up. It moves up. I hit 1 profit target. Next day moves up big. I believe I hit 2 profit targets. Close to 3, but I think it was 2. So I'm taking profits. On this particular day, I got to trailing stop level. What does that mean? If I have a close below a previous bar's low, I'm going to get out of half. Okay, next day didn't do much. Next day gapped open, hit another profit target. Next day moves up, hit another profit target. I'm in trailing stop mode, but it hasn't closed below previous bar's low. And then the last 3 days, we've kind of moved sideways, no profit targets, but we haven't closed below the previous bar's low. So just holding steady so far on this particular trade, up pretty nice, up 4.9%, just waiting patiently for the signal, which was the deep dip buy, rejection of the 200, cherry on top was the V1. So that is IWM. Monday, if we close below Friday's low, what do? I take off half of the remaining shares. If it keeps moving up, I continue to take partial profits. We're at a 55.35 RSI. If we get to a 65 RSI, then another rule kicks in, a trailing stop rule using the 5 EMA. If we go up to the 70 RSI and we reject the 70 RSI, then I get out of half. And then once I get out of half, if I have a close below a previous bar's low, I'm out of the entire trade. I've been trading for almost 30 years. I have rules for everything. There's a purpose for every rule, whether offense, defense. But the real key is I have a plan. no matter what happens on Monday, I know what to do. If it goes up, I do this. If it goes down, I do that. And that's what you need in a trading plan. And if you don't have a trading plan, I'd be very happy to teach you all mine. I trade 7 different strategies. I teach a one-on-one course in the evening time via Skype. It's a 15-hour course. Each session is 3 hours, and I teach 5 sessions. I've taught people from all over the world, from all levels, from absolute beginners all the way up to the hedge fund level, and I would love to be able to teach you. I love to teach. I think I teach well, and all of my students have always said, Greg, I learned so much in your course, and I feel like I have a skill now that I can use for the rest of my life. So if you're interested, my email is in the description below. Just contact me and tell me, Greg, I'm kind of interested in taking your course. I'll respond back, and I'll teach you everything I know. I know you'll love it, and it's money well spent. So, okay, IWM, we went through that very thoroughly. Going forward, I won't be as detailed, but remaining shares on IWM up 4.9% using the deep dip buy. So that's IWM. Let's go to ARK. All right, ARK. I have a red band here. Red bands mean I'm looking too short. So I did short ARK on the 6th of January at $61.12. Why? Well, it all started with this big bar down. This is when we changed market structure from up to down in this particular market. This big bar down here took out the low here. This changed to a bearish market structure. And so this is called an order block. An order block is your highest up bar close before market structure change. When that happens, you don't do anything. What I do is I wait for a rally back up into the bearish order block. I know this doesn't look bearish because it's so far up. So this happened. Then here on the 6th of January, we went up, we rejected the order block. The high and the low, the top and bottom are the reds. We rejected the order block. I got short here at $61.12. My emergency stop is 2 ATRs above right here, and my end of bar stop is a close above the high of this order block. And so I got short here, 61.12. I placed my 1.5 ATR trailing stop level below because I'm short this time. And again, my stops are 2 ATRs above and a close above the high of the order block here at 63.12. The next day, nailed it, went down, took 2 profit targets to the downside because I'm short, reduced the position size. The next day we go down again. I hit 1 more profit target, and then also we get to trailing stop level, 1.5 ATRs below my entry because I'm short. The next day down again, took more profit targets. The next day down again, took more profit targets. Here, then we started to rally up. Here, I got out of half of all the remaining shares that I have. Why? Because we got to trailing stop level and we have a close above a previous bar's high because I'm short. Locked in half at a gain of 4.46%. Then we went on a tear. But remember, I took a huge amount of profits on the way down using the offensive portion, right? And then exited half of everything here, like I said, for a gain of 4.46%. And then we just went straight up. Remember, my stop on the remaining shares is a close above 63.20. You can see on Friday, we did get above there. I thought I was going to get stopped out on the remaining shares, but no, it closed back below and kept me short. So the remaining shares, I have a loss of 1.96% on the remaining shares. But overall, am I still positive on the trade? Absolutely, because I took the huge amount of profits using the offensive approach to my trading here and then half of everything here. So yes, the remaining shares I have, loss of 1.96%, but overall still nicely positive on this trade because of the rules that I use. That's why I have all these rules. So remaining shares down 1.96%. Okay, let's get to India, INDA. Okay, so this particular strategy is called an abandoned baby. An abandoned baby and island reversal are very similar. Abandoned baby uses 1 bar, island reversal uses 2 or more bars. An abandoned baby is this: when you gap down, but the next day immediately you gap up. When this happens, more times than not, about 70% of the time, when I look into the future, if I have a gap down immediately followed by a gap up and I look out in the future, I'm going to have a higher price. Why? Because you had very negative sentiment very quickly, followed by bullish sentiment very quickly. And on these particular approaches, on these particular trades, I make them very simple. I have, what happened to my, huh, sorry about that. I must have accidentally deleted my profit target on this. Yeah, that's right about here. So on this particular setup, I make it very simple. One of two things is going to happen. I set a 2 ATR stop below me, and I set a 4 ATR profit target above me. I just put them in the system, 2 ATR stop, 4 ATR profit target, and I just let it go. I'm either going to make 4 ATRs or I'm going to lose 2 ATRs, and that's it. But in my experience, 70% of the time I make 4 ATRs, 30% of the time I lose 2 ATRs. And if you've been following this channel, you'll have seen me place many trades like this and hit many 4 ATR profit targets. Now, this one is down at the moment, very, very small, down 0.41%. But the reason I got in here, I could have just got in here when the abandoned baby formed, but I usually wait. Usually what happens is you get the bounce and then you come back before you head up, and that's when I got in here at 50.83 because it came back to the top of the abandoned baby. So currently down 0.41%, but again, 2 ATR stop to the bottom, 4 ATR profit target to the top. So that's INDA. These are kind of set it and forget it. I don't scale out. This one I just try to make as easy as possible because it's really such a strong signal. Okay, so that's INDA, and then let's go with gold. Gold, I entered short on Friday. Why did I do this? Well, this is, you see the red block here. This means I'm looking for a short. This was your highest up bar close before obvious market structure change. This is a bearish order block. And on Friday, we got right to the bottom of the order block and rejected. If it had closed in the order block, I would not have done anything. But on this particular trade, because it rejected, that's why I entered. So I entered at $256.60 short. I placed my emergency stop above 2 ATRs. My end of bar stops that close above the high of the order block of 10:30.24 at 257.51, and I placed my 1.5 ATR trailing stop level to the downside to tell me when to get in trailing stop mode. So I know exactly what I'm going to do. On Monday, if we close above the high of the order block, I'm simply out. If we race up, get to my emergency stop, obviously I'm out as soon as it touches. How much will I lose? 1%. To the downside, if it starts moving down, I take partial profits. If I get to trailing stop level, then I go into trailing stop mode. So basically, I got into this trade exactly where it's at. So we'll just call that break even. So those are the 4 open trades. IWM up 4.9%. ARKK remaining shares down 1.96%. INDA remaining shares down 0.41%, and gold break even. Okay, let's go to the closed trades. This is QQQ. All right, I did get long on the QQQ back here on January 14th at $505.10. Why? Well, this is a little bit of an orthodox trade in many ways. You can see this bottom here, this bottom here. This is basically a channel trade where I connect this bottom to this bottom. I go out into the future. This is the trend line. On the 13th of January, we went under the trend line, closed back above it. That was a good bullish sign. Did not take the trade there. The next day, we came back and back tested that trend line and then closed above it. So that showed me that the market changed, rejected the trend line, tested it, still buyers went up. So I got long here, 505.10. My end of bar stop was simply a close below the trend line. My emergency stop, 2 ATRs below. My trailing stop level, 1.5 ATRs above. Next day, nailed it. It gapped up. What did I do? I took some profits. Next day, opened up higher, went to the trailing stop level. So now I'm in trailing stop mode. No profit targets on that day, but I am in trailing stop mode. Next day, gapped up nicely again, took more profit targets. Next day, went up, hit more profit targets. And then here on the 22nd, it gapped open, went higher, took more profit targets. But on this particular trade, I called an audible. I don't do it very often. I usually just stick with the process. But why did I exit here? Well, look, here is the order block, the highest up bar close before market structure change. If I was not in this trade long, I would have gotten short here because the rejection of the order block. So I was long. So if I'm long, but if I wasn't long, I'd be short. Why am I staying in the trade? Makes sense? So I simply just exited the trade here with rejection of the order block. Nice trade, up about 4.99%. So hope that makes sense. Normally, if I did not call the audible, I would still be in the trade looking for a close below previous bar's low. But again, because we rejected this order block and that's such a strong signal, I just decided at that moment it's legitimate to get out and lock in the 4.99%. So pretty good trade on Qs. And then Intel. Okay, this one's a long one. Okay, you see the green box here. The green box means that's a bullish order block. This one has a long history. We go all the way back here to the 7th of August. We have a bullish order block. It's our lowest bar close before we change market structure to the upside. If you change market structure to the upside, I want to buy when we come back into the green box. And I've already done this on this particular trade. I did this here back on 9/11 when we rejected the bottom of the order block and formed a V2, and I had that nice trade there. But these bullish order blocks tend to have memory. So when we get back into these order blocks, I want to look to buy. So here on the 10th of December, I bought. Why? One, we're in the bullish order block. Two, deep dip buy. We have an under 30, over 30 on that particular day. So that was my entry price, 2022. Position size correctly, place my emergency stop, 2 ATRs below as always. My end of bar stops just a close below the low of the order block, 1890. Place my 1.5 ATR trailing stop level there. The trade started out good, took some profits targets here, but then we came down. But look at this. We get right to the bottom of the order block, and that's exactly where we bounced. Then I came up here, took a little bit of profits, then we had the big move down again. But look, 1 day, 2 days, 3 days, we tested the low of that order block, 1890. You see how important the bottom and the top of those order blocks are, and it kept me in the trade. Now, deep dip buy, if I take a trade with an under 30, over 30, I have certain rules and they serve me well on this trade. Well, then at the beginning of last week, we went up nicely, took profit targets here. On the 21st, I exited half of my position. Why? Because we rejected the 50-day moving average. You see how during the day we went above it and then yet we closed below it? So if I take an under 30, over 30 dip buy, if my students are listening, they know because I've taught them this, I exit half of the position. So I exited half of the position for a gain of 7.31%. But the other rule is under 30 under 30 over 30 only is if I have a rejection of the 50-day moving average, and then it's the next in the future, if I have a close below previous bar's low, that's when I get out of the second part of the position. And that's what I did on, I guess that's Wednesday. So I am out of the trade, luckily, because look what happened on Friday. But the rejection of the 50 got me out of half for a gain of 7.11%. The close below the previous bar's low on Thursday got me out of the second half. And so now I am done with this trade, and that was 6.31%. So nice trades. I was in this trade quite a long time, but it worked out well, and I'm glad I had my rules there to get me out before the move down on Friday. Okay, so close trades, Google, I'm sorry, not Google, but Q's locked in a gain of 4.99, and Intel locked in a gain of 7.1. Golly, I can't read that. Okay, what's happening? 6.31% and 7.14%. Okay, on to the weekly trades. Weekly trades close on Friday. Weekly bars close on Friday, and so I make my decisions at the end. I got long on a weekly bar, Home Depot here on 110.10. Why? What was the strategy? The strategy is what's called a return to value V1 or V2. This was a V2. I'm sorry, a V1. A value zone is this green line and this green line. Anywhere in here is considered the value zone. This particular strategy, which I use and I teach all my students, we first need to close above the value zone. We did close above the value zone. Secondly, we need to come into the value zone. We did come into the value zone. Third, I need sideways motion. I need the bars not going up or down for at least 2 bars. That happened. And then when all of that is in place, if I get a V1 or a V2, I can take the trade, and that's what I did. Here's a V1, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. I got long 389.85, position size correctly, placed my emergency stop 2 ATRs below. On this particular trade, my end of bar stop is a close below halfway of the washout bar, the high and the low of the washout bar. We call it the washout bar because this is bar 2 that washed out bar 1 here. Place my trailing stop level 1.5 ATRs above. That is the trade. So in at 389.85. Of course, I take partial profits on this if the market gives it to me, and I nailed it right up. 2 weeks ago, we got to trailing stop level. This week went up, hit another profit target. So I'm at trailing stop level, and this particular trade on the weekly up 5.96%. So again, return to value V1 above the value zone. Come into the value zone. Sideways motion, V1 or V2 trigger. This was a V1 in at 389.85. And set everything up. So this worked out really well and great trade. Earnings coming up. I will get out before earnings. So that's Home Depot. And then TLT. This one hasn't done much. You see the green box. This means this is a bullish order block. And this one goes all the way back to 10/20 of 23. Our lowest bar close before market structure change. That means once it changes structure to the upside and gets back to the order block, the green box, that's where I want to buy. I bought 2 weeks ago when the price came into the order block, closed up and rejected it, closed back above the order block. 87.18 was my entry point. My stop on this particular trade is a close below 85.70, and 85.70 is referenced all the way back here to the 3rd of November. The big up bar, if you have a big up bar, halfway of the big up bar of 50% will be the support. So I draw that out into time, and that is my end of bar stop is a close below 85.70. Of course, I have my emergency stop down there too. So this one exactly even. 80, I got in 87.18. Oh, it's 87.19. Okay, I'm up a penny, but basically even on this particular trade. So those are all the open trades, closed trades. Pretty good week, all in all. And so I hope you found this helpful. So, all right, let's talk before we get into the potential trades that I'm looking for next week. Let's talk a little bit about trader psychology. This is again from Stephen Burns. You can follow Steve at @SJosephBurns on Twitter. Let's see what Steve has to say. Too much excitement in trading is a sign of bad risk management. Proper position sizing should not create a lot of stress and emotion. Okay, there's a fine line in trading. If you are not sleeping, if there's too much excitement, your heart rate is up on every tick, what does that mean? That means your position size is too small. If you have no heart rate, if you have no excitement, if you have nothing, that probably means your position size is too small. If your heart rate's really going, your position size is too high. If you have nothing, no heartbeat, the position size is too low. We need to find that good, happy medium where gains are substantial, right? I mean, if it moves up, you want to make sure that it's worth your time. But if it goes down, you don't want to stress yourself out too much. And really, trading should be boring, but it's a fine line of being too excited or not excited enough. But really, if you're not sleeping, if your heart rate's pounding, your position size is too high. One, it's not healthy. And two, I always come back to this, but two, if you're stressed out about every single tick, all that means is that eventually you're not going to follow your plan. You need to find the proper position size that it's still worth being in the trade. It's still worth putting the work into the trade, but that you can follow position size. If you have this huge position size, you're never going to follow the plan that you set out. The emotions are just going to get the best of you. So too much excitement in trading is a sign of bad risk management. Proper position sizing should not create a lot of stress and emotions. The key word, a lot. There should be some, because if there's none, it's really not worth your time. So what I showed you with the way that I position size, 1% of my capital divided by the value of the 2 ATR for me, that works perfect. There's still going to be a little stress. There's still going to be some emotions, but not so much that I'm not going to follow my plan. I always revert back to this. Follow your plan. And if you buy one share of something, sure, you're going to follow your plan just fine, but it's not going to be worth your time. So you have to find that happy medium, that perfect position sizing, that it's worth your time, but it's not so big that it's not going to get it, that you're still going to follow your trading plan and you're not going to divert from your trading plan. And again, what I use, 1% of the capital divided by the value of the 2 ATR, for me, that's what really works. So thank you, Steve. I appreciate that. And now let's get over to the potential trades for next week and see what we have. Okay, so on the dailies, these are the 5 symbols. These are the 5 markets that I am looking for. I always like to mention this, though, before we get into this. I have 5 potential trades. These could potentially all trigger on Monday or sometime next week. Does that mean I would take all 5 of the positions? No, I have a rule where I only take 1 position per day per time frame. And next week all 5 of these could trigger on the same day, but I have to have the ability to narrow them down to the best trade. How do I do that? Well, basically what I do is I create a quality score for each trade. For example, if it has 1 entry signal, it gets 1 point. If it has 2, it gets 2. If it has 3, it gets 3, and so on. And I'm going to take the one that has the highest quality score. So how many entry signals are there? What's the risk to reward ratio? How does it look on a higher time frame? The relative strength of that particular market compared to the market in general. This is an important skill to be able to have to narrow down and look for the best one when you have multiple candidates. And this is what I teach my students. This is what I teach in my courses. But just want to point this out that I'm only going to take the highest quality score. All right. So here is Apple. Now, Apple, for some reason, went straight up. And then everybody decided they didn't want it, went straight down. So we are getting into deep dip buy territory here by the fact that we are coming to the 200-day moving average. Now, historically, buying Apple with some kind of rejection of the 200-day moving average is a really good risk to reward ratio. But we have earnings on the 30th. Now, how am I going to handle this? If we rejected the 200-day moving average on Monday, for example, would I take the trade and hold it for 2 or 3 days before earnings? Because remember, I never hold through earnings. It's possible. It's not going to be a very long trade. It might be 1 day or 2 days. But if I did that, I'm going to get out before earnings. Now, I think the earnings is on the 30th, which is, what is that, Thursday? Yeah, that's Thursday. So after earnings happen, we may go under the 200-day before earnings, but then after earnings, close above the 200-day. So that's a potential. So probably not likely that I'm going to take Apple before earnings. Possible, but not likely. But for some reason on Thursday, if we have earnings and then it goes under, but then Friday it closes back over, then I could take the trade because then earnings are out of the way. But the other thing I want to point out here is the green box. This green box is a island reversal. Remember I talked about island reversals? Look, here on the 13th of November, we gapped down. We had 1 day sideways, then we gapped up. This creates an bullish island reversal. Was that the right move? Yeah, I would say so. But look, we're coming right back down to the top of that island reversal. 217 is the island reversal. And the 200-day moving average is 217.80. So this really looks like a bit of a sweet spot to buy Apple. Now, maybe they have really bad earnings and we head back down. I don't know. But technically, this is an interesting area. One, because of the 200, and two, because it was the high of the island reversal back here. So I would say somewhere between 217.10 and 213 is really a sweet spot for Apple. But I can't just say that. I have to wait and let the price action show me that, one, either we've rejected the 200-day moving average or we've rejected the high of the island reversal back here at 216.98. So I'm going to let this play out, but I think this is a good opportunity on a stock like Apple. One, because it's a big, successful, profitable company, and two, the technicals are really lining up here in this area between 217.10 and 214. So 214 to 217, roughly call it. That's a real sweet spot. And then obviously we have just gone straight down. I mean, eventually Apple will bounce, but we'll see if this strong technical area is the location. So I'm going to be watching Apple closely next week, essentially more so after earnings, to see if it rejects the high of the order block, or the high of the island reversal, basically 217 to 213, somewhere in this range, or the 200-day moving average. I wish I could be more specific on this, but with earnings, I have to wait and see. But I'm just saying, kind of experience-wise, I think this is the bounceable area right here. So we'll find out. MSDL. I don't talk a lot about MSDL. It's Morgan Stanley Direct Lending. It's a high income ETF. It yields about 10%, by the way, and it does pay monthly dividends. But what I'm looking for here is simply a rejection of the 200-day moving average. 200-day moving average, again, deep dip buy is the black line. But what's the confluence? The confluence is, and I've mentioned this many times, let's look at the gray line and the black line. The gray line is the 50-day moving average. The black line is the 200-day moving average. This is called the golden cross. When the 50 crosses the 200-day moving average, that's a golden cross. But what I've noticed in all my years of trading is once you have a golden cross, very often the price will come down to the 200. And the first bounce or rejection at the 200-day moving average after the golden cross has happened is usually a very good time to buy a deep dip buy off of the 200-day. Buying off of the 200-day just by itself is legitimate anytime, but when you have the golden cross preceding it and then you get to the 200, that's when you tend to get really big bounces. And again, this is deep dip buy. I forgot to mention, if you like online video classes, I have a really good online course at udemy.com. The link is in the description of this YouTube video. It's a 9.5-hour course. It's affordable. It's somewhere between $30 and $50, but it's 9.5 hours, and I teach you step by step by step every single rule, everything I look for deep dip buys. And deep dip buys include 250-day moving average, 200-day moving average, 300-day moving average, 30 RSI levels, and a combination of both. I mean, what I'm talking about here on MSDL is a deep dip buy off of this 200. But if you want a very structured course, the Udemy course that I have for the deep dip buy is really, really good one. So it's the links in the description. So, but that's what I'm looking for on MSDL. This is a nice stock to buy as long as it's above the 200, because like I said, it yields like 10% paid monthly. And as long as it's over that 200-day, I think I'd probably just hold that. If it closes below, I'm just going to get out. You don't want to get into a dividend stock and just hold it forever. You still need a line in the sand, and that 200-day moving average would be a great line in the sand, especially because the 50 crossing over the 200. So I'm just looking for some kind of either bounce, intraday rejection of the 200, or close under, close over the 200 to get in there. That's what I'm looking for in MSDL next week. UAL, United Airlines. Okay, well, you see a red box. That means I'm looking to short. Why? Well, we had this big blow off top here on UAL. We gapped up high. We reversed back down. Thursday, we took out the swing low. What does that mean? It means that we've gone from a bullish market structure to a bearish market structure. When you go from bullish to bearish, I want to look to short any rallies, because you want to buy dips in an uptrend. You want to short rallies in a downtrend. This isn't a downtrend now. Again, why? Because Thursday we took out this swing low. We also broke the trend line to the downside. So any move back up to the bottom of the order block, the order block here is 108.30 up to, looks like 110.92. And look, it already did that on Friday. See how we gapped up? We went right almost to the penny to the bottom of this order block and then rejected. Pretty incredible, right? Those order blocks are the real deal. So I didn't take this trade. I actually didn't see it till this weekend. But next week, if we do rally back up and reject the bottom of the order block, I would consider getting short there. If we close in the order block, I'm not going to do anything. I want it to reject the order block. But if we go higher and reject the top of the order block, I would also potentially get short here. But this move down on the 22nd, this tells me very likely that the top is in on United Airlines and to sell any potential rallies. Because when you have a big move down like this, it's natural for buyers to come in to buy and have an attempted move back up. But if you have an attempted move back up and it fails, that's when you'll get the long move down. And, talking about the indexes as well, I'm really concerned for the indexes. I think the tops are in. Again, that's why I got out of the Q position, because we rejected that order block. I could be wrong. I definitely could be wrong. I'm wrong a lot, but I'm right a lot too. And but back to UAL, this looks like to me the top is in, so I'll be looking to short any rally with the rejection of 108.12 on the bottom side or 110.79 to the upside. Walmart, looking for another short on Walmart. I talked about this last week. Again, The red area is the bearish order block. It's the highest up bar close right before market structure change. So looking to short any rallies up into the order block. I did not short here because it did not reject the order block. We stayed above halfway of the big down bar. This red line is important because it's this big down bar. Actually, I drew that a little bit funky. There we go. This big down bar here on the 18th, when you have a big down bar and then you have a move into that bar, that's usually where it will fail. Had this rejected the halfway of this bar here at 94.50, had it rejected it, I probably would have taken a short on Walmart, but it closed above it. That's why I didn't. So if we move back down below it, I may enter a short there. Or if we go back up and test the high of this order block here at about 95.55, I would consider getting short there as well. So just basically, if we go and close below 94.50 and we reject the halfway of the big down bar on 12.18, I would consider getting short there. Or if we go higher and reject the high of the order block, I would consider getting short there. And that scenario would even give me a better risk to reward ratio because, I mean, the stop on this trade is the high above the order block of 95.49. So if we go above 95.49 and then close at like 95.40, then my stop is so close at 95.49. So I'm looking for a short on Walmart. Exxon, okay, you see green, that means I'm looking to buy. Why? Order block back here on the 19th of December. Lowest bar close before market structure change. Market structure to the upside. Markets, when you change market structure to the upside, a lot of times you have a bit of a pullback before you bounce again. I'm looking to buy Exxon with the rejection of the high or the low of the order block. The high is 107.67. The low is 105.21. So for example, if Friday we would have done this, I would have considered getting long. Why? Because it came down, rejected the high of the order block, and bounced off it. It didn't do that. I'm just manipulating that. But next week, if we come down, test the high of that order block and bounce above it, that would very likely be a place for me to get long. That's one scenario. Another scenario is if we come down deeper into the order block, bullish order block, and then maybe have a V1 or a V2. That would be a good entry signal. And last would be if it comes all the way down, test the bottom of the order block at 105.20 and bounces from there. That would be another scenario, and that one would have the best risk to reward ratio. So I am looking to get long Exxon with some kind of price action between 107.67 and 105.21. So those are the dailies. Let's finish up with the weeklies. These are weekly bars. Make decisions on Friday. Okay, look at AMD. Well, AMD has earnings next week on the 28th. So I'm not going to get involved in this until after the earnings, but I wouldn't get involved anyway because I don't make a decision on this until Friday. So come Friday, if we have rejected the 200-week moving average, I would consider getting long there. I love weekly trades. You can stay in them a long time. The percentages are really high, but I need some kind of rejection of the 200-day. Now, look, for the last 2 weeks, it has rejected the 200-day moving average. Here, it rejected, closed above. Here, it bounced. So far, there are buyers at this 115 level. So technically, yes, could have got in here, you'd be in the money already, but we have earnings coming. I want to get the earnings out of the way. But if on earnings we go under the 200 or test the 200 and then close back above, I would definitely consider getting along AMD using that 200-week moving average as my line in the sand. DDM, which is the double leverage Dow. Okay. Here's an order block. Again, this is weekly. Here's an order block. Here's your highest up bar close before market structure change. If you market structure change to the downside, you want to look to short rallies. So I'd be looking to short the order block of 11.29. The high is 107.53. The low is 104.52. We did not quite get to the bottom of the order block. Had we, got there and rejected it, I would consider getting short, just like I got short on ARKK. But it's not there yet. So next week, if we reject the bottom of the order block, I consider getting short. If we reject the high of the order block, I will also consider getting short there as well. FXY, which is the Japanese yen, been talking about this for a while. We just haven't got to this level. Just being patient. This is a very defined order block here back on the 28th of June, lowest bar close before market structure change. Months have gone by in order to get back to this order block. We have not gotten there yet. We're getting close, but next week, if we reject the high of the order block, which is 58.06, I would consider getting long, or if we reject the low of the order block at 57.49, I would consider getting long, because this is a decent area to buy. Bullish order blocks are always a good place to buy. It doesn't mean they're always going to be profitable, but they're good sweet spots to buy. So that's FXY. VIX, okay, another order block. This one goes all the way back to the 12th of July. Lowest up bar close. Clearly, we broke structure to the upside. Now you can see every time we've gotten back down to the bullish order block, like here, I didn't take this trade. I wish I would have. It rejected the high of the order block and then boom. Now we are in the bullish order block on VIX, but we did not reject it. Had this closed back above the high of that order block there at 41.90, I would have gotten long VIX. And so next week, if we go lower, reject the bottom of the order block, I could get long. And the bottom is right there at about $39.97, about $40. Or if we close back above the order block, I could get long here. This is what concerns me about the market in general, everyone, is because, VIX is usually inverse of the market. If the market goes up, VIX goes down. If the market goes down, VIX more likely goes up. Well, we are in the place where VIX is likely to bounce and potentially bounce big. So what do you think is going to happen to the market? The market would go down. And looking at the technicals of the market, I don't like them either, right? We're up into order blocks right now. So it makes me actually quite bearish on the market. And that's why I'm looking for potential long on VIX. And then last but not least, XLU, utilities, another order block. Highest up bar close before market structure change. Market structure changes to the downside. I want to look to short rallies. First place to short the rally would be the bottom of this order block at 81, the high 83.41. So this is a shortable area. So those are what I'm looking for on the weeklies. And I just talked about the markets in general. Again, on the Qs, on the daily, we are right. That's why I exited the trade on the 22nd. We rejected the bottom of the order block on the Qs. More than likely, we go down. Doesn't mean it has to be Monday or Tuesday, but in the future, more than likely, we are going to be lower. Let's take a look at the SPY. Same with SPY. We rejected the order block. Here's the order block on the 11th. We got above it on Thursday, but now we rejected above the order block and came back down into it. So be a little careful, everyone, because the major indexes are showing tops, right? And more trades than not, I'm looking to short. So again, if you'd like to be a student of mine, I have a great one-on-one course, 15 hours. Love to teach you. I'll teach you everything I know. You're going to learn a great skill. Just send me an email and we can start the discussion. If you're interested in the the video course on udemy.com, the link's there as well. If you have any questions about anything I discussed today, feel free to put them in the comment section. I'll do my best to get back to you, but I appreciate you being here. Please try to go out and do something nice for somebody today. Would make the world a better place if you did that. If we all did that, try to go out and do something nice for an animal. They appreciate acts of kindness just like we do. But I really appreciate your time. I hope that you found it helpful, everyone. And God willing, I will be recording this next week from Colombia. So have a great rest of your weekend, everybody. Appreciate you being here. Take care. Bye-bye.
U.S. Government Disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.